Hello and welcome to today's episode. In today's episode, we will discuss about the regulation of money and capital market and the measures taken by RBI and Sebi in this regard. I am Dr. Arshia Hussain, PhD in Human Resource Management and teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia, New Delhi. So let us start this episode with the meaning of money market. Money market can be defined as a market for short-term loanable funds and financial assets that are near substitutes for money. Short-term means a period up to 1 year, and near substitutes to money is used to represent any financial asset which can be quickly converted into money with minimum transaction cost. It is an important segment of the Indian financial system. It plays an important role in maintaining equilibrium between short-term demand for and supply of money. Money market comes under the purview of the RBI. Now we will discuss participants in money market. The first participant in money market are the lenders. These are entities or individuals with surplus lendable funds like financial institutions, banks, that is commercial, cooperative and private banks. They have bulk lendable resources with minimum of rupees 3 crore per transaction. The second participants are borrowers. These are entities or individuals with deficit funds. Now we will see features of money market. The first feature is money market operations are for short-term funds. Second, it deals with call money, notice money, repos, term money, treasury bills, commercial bills, certificates of deposits, commercial papers and so on. The third feature is money market is liquid. It can be turned over quickly at a low cost. The fourth one is money market maintains equilibrium between short-term demand for and supply of money. The fifth feature is money market can be considered as a source of working capital finance for the industry. Sixth one, money market is impersonal in character, so that competition is relatively pure. The seventh one is a network of large number of participants deal in the money market. Next is money market is a wholesale market since the volume of funds traded in the market is very large. The next is functions in the money market require the service of skilled professionals. Next feature is the trading in money market takes place over telephones which are followed by written contract confirmations. Next feature is money market transactions are generally settled the same day. Now we will discuss money market instruments. The money market instruments are, first one, call money. Call money is the shortest form of funds. It is generally overnight borrowing and lending. In other words, it is an amount borrowed or lent on demand for a very short period. If the period is more than 1 day and up to 14 days, then it is called notice money. Otherwise, the amount is known as call money. The minimum period is 2 days. Now, we will see features of call money market. The first one is The call money market facilitates the banks and institutions to meet their day-to-day deficits and surpluses of money. The second one is only scheduled commercial banks, cooperative banks and primary dealers are permitted to participate in call money market. The third one is the interest rates in the call and notice money market is determined by demand and supply factor. Fourth one is the participants in call money market are free to decide the interest rate. Next is it serves as an outlet for deploying funds on short-term basis to the lenders having a steady inflow of funds. Next is commercial bills. Commercial bills are short-term negotiable and self-liquidating financial instruments. The risk factor is very low. The seller of goods draws these bills on the buyer for the value of the goods delivered. These are bills of exchange. The seller's bank usually send the bill to the buyer's bank for delivery of the documents of title to goods like lorry receipt or railway receipt against acceptance of the bill by the buyer. The buyer's bank will get the signature of the buyer on the bill of the exchange and also add their signature before delivery of the documents to the buyer. The co-accepted bills are known as commercial bills and co-accepted bill will be sent to the seller. If the seller is in need of funds, then he can discount the bills with the seller's banker who can rediscount the bill in the commercial bill discount market. Next is certificate of deposits. A certificate of deposit, commonly known as CD, is a marketable receipt of funds deposited in a bank for a fixed period of time. They are negotiable money market instruments which are issued in a dematerialized form for a specific period of time. They are freely transferable by endorsement and delivery. It is subject to stamp duty like the usance promissory notes. All scheduled commercial banks, excluding regional rural banks and local area banks and all Indian financial institutions, issue CDs for raising short-term resources within an umbrella limit fixed by the RBI. The minimum subscription amount is rupees 1 lakh and additional investment should be in multiples of rupees 1 lakh. The minimum maturity period is 7 days and minimum of 1 year. However, financial institutions can issue CDs of not less than 1 year and not more than 3 years. Individuals, corporations, companies, trust funds, corporations, etc. can subscribe to CDs. Non-residents of India can also subscribe to CDs on the non-transferable basis. Next we will see is commercial papers. Commercial papers is a short-term negotiable instrument. It was introduced in the Indian money market in the year 1990. It was launched with a view to enabling highly rated corporate borrowers to diversify their sources of short-term borrowings and also providing an additional instrument to investors. Subsequently, primary dealers and all Indian financial institutions were also permitted to issue CPs for meeting their short-term requirements. Any private sector or public sector company can issue CPs provided it satisfies the following conditions. The first condition is it has a minimum tangible net worth of rupees 4 crores as per its latest audited balance sheet. The second one is it enjoys a working capital limit from a bank or an all India financial institution. The third condition is the borrowed amount of the company is classified as a standard asset by the bank or financial institution. And the last condition is the instrument has a minimum credit rating of P2 by CRISIL or an equivalent rating by other rating agencies. There is one more condition, that is the minimum maturity period is 7 days and the maximum is 1 year. CPs can be issued in denominations of rupees 5 lakhs or multiples thereof, and the minimum investment of a single investor should not be less than 5 lakhs. That is the face value. Next we will discuss is Treasury Bills. Treasury Bills are short-term negotiable instruments issued by the central government. In the short term, Treasury bills are the lowest risk category instruments. They are promissory notes issued by the Reserve Bank on behalf of the Government of India for financing temporary deficits resulting due to the difference between revenue and capital receipts and payments. Now, we will see the features of Treasury bills. The main features of Treasury bills are: first one, Treasury bills are negotiable instruments. Second, Treasury bills are issued at a discount and the face value would be paid on maturity. The third one is the return on Treasury bills is the difference between selling price and the face value. Fourth one is Treasury bills enjoy high liquidity since the duration of these bills vary from 91 days to 364 days. Next is Treasury bills are the lowest category instruments as they are supported by government guarantee. Next is Treasury bills offer an assured return. Next is the transaction cost on Treasury bills are non-existent and trading is considerably high in each bill. Next is the purchase and sale of these bills are done through auctions and are settled through SGL, that is Security General Ledger account with the RBI. The Treasury bills are introduced by the RBI as a monetization of budget deficit of the government. These bills are sold through bid process. There are 4 types of Treasury bills. First one is 14-day Treasury bill. Treasury bills with a maturity period of 14 days. Its auction is on every Friday of every week. The notified amount for this auction is rupees 100 crores. Second is 91-day Treasury bill with a maturity period of 91 days. Its auction is on every Friday of every week. The notified amount for this auction is rupees 100 crores. The third one is 182-day Treasury bill with a maturity period of 182 days are also available. These bills were introduced by the RBI in the year 1986 to promote short-term liquidity requirements. Its auction is on every alternate Wednesday. The notified amount for this auction is rupees 100 crore. Next is 364-day Treasury bill with a maturity period of 364 days. 364-day T-bill was introduced by the Government of India in the year 1992 to stabilize the monetary market. These bills are sold through fortnightly auctions conducted by the RBI. The notified amount for this auction is rupees 500 crores. Now, Treasury bills of 364 carry a higher yield and a better liquidity and safety. Now, we will see disadvantages of Indian money market. First one is there is a lack of integration between organized and unorganized sector. Second one is multiple rate of interest exist in Indian money market leading to confusion among the investors. The third one is Indian money market faces shortage of insufficient funds or resources. The fourth one is investment instrument such as Treasury bills, commercial bills, certificates of deposits, commercial papers, etc. are inadequate. Next is the scope of commercial bills is limited since a large number of transactions are preferred in the cash form. Next is the banking system suffers from major weaknesses such as NPAs, huge losses and poor efficiency. Thus, absence of the organized banking system is a major problem for Indian money market. Next is there are less number of dealers who can act as mediators between the government and the banking system. Lesser number of dealers leads to the slow contact between the end lender and the end borrowers. Now, we will see recent measures taken by the RBI in this regard. The RBI is the supreme authority in the money market. It has the powers to regulate, coordinate and guide the money market. The RBI has taken several steps to develop money market. The following measures are recently taken by the RBI to strengthen the market. The first measure is the RBI has taken steps to promote the Discount and Finance House of India in order to increase the liquidity of the money market. Second one is the RBI permitted in 1991 to set up money market mutual fund by the scheduled commercial banks and their subsidiaries. This mutual fund would provide additional short-term funds to the money market. Next is the RBI introduced an effective interest rate on bill discounting in the April 1987. The ceiling rate has also been raised from 11.5% to 12.5%. Next is RBI has been taking several steps to increase the players in the bill rediscounting market. Next is the RBI has been introducing several treasury bills in the money market. In the year 1987, 182 days treasury bills. In 1992 to 93, 364-day treasury bills were introduced. So, these bills were taken into consideration for SCR. Next is the RBI had been taking total deregulation of money market interest rates with effect from 1st May 1989. Next is the RBI permitted the CDs into the money market in the year 1989. Next is the RBI liberalized the credit authorization in July 1987. The RBI also promoted DFHI, that is Discount and Finance House of India, in order to increase the liquidity of the money market instrument. As a result of various measures taken by the RBI, the money market became more organized and diversified. Now, the next topic that we will discuss is the capital market. The capital market is the market for long-term loanable funds. The capital market is divided into primary and secondary markets. Primary market is a market for new issues of shares, debentures and bonds. The investor applies directly to the issuer for allotment. They pay application money to the issuer's account. The transactions in the primary market result in new capital formation. Now, we will see participants in primary market. There are 4 participants. Number 1, issuers. Number 2, instruments. Number 3, intermediaries. And number 4 is investors. The first type of participant is the issuers. The corporations, government or mutual funds are the issuers. They start the whole process of raising funds. Funds are raised through public issues, right issues or through private placements and preferential allotments. Next is instruments. The means through which issuers raise funds are called instruments. Debentures, equity shares, warrants, etc. are examples of instruments. The third player or the participant are the intermediaries. They are the people who facilitate the flow of funds from a person having excess funds to the person who needs it. They help issuer in raising funds by issuing securities through selected instruments. The next participants are investors. People who invest their surplus money in securities are called investors. The investor may be an individual, corporate, financial institution, foreign institutional investor and so on. Now, we will discuss secondary market. The secondary market is a market for the secondary sale of securities. In other words, the market where existing securities are traded is referred to as secondary market or the stock market. In the stock market, securities of government, semi-government and other public bodies as well as shares and debentures issued by joint stock companies are traded. The Securities Contract Regulation Act of 1956 defines a stock exchange as an association, organization or body of individuals, whether incorporated or not, established for the purpose of assisting, regulating and controlling business in buying, selling and dealing in securities. Thus, a stock exchange is an organization which provides a market for second-hand securities that have been listed thereon. Stock exchanges in India operate with due recognition from the government under the Securities Contracts and Regulation Act of 1956. The market functions from the trading floors of stock exchanges. Trading activities are supervised and regulated by stock exchanges, insisting on a margin on trading. They also control the badla transactions and keep an eye on the speculative tendencies. The stock exchanges ensure proper delivery of scrips and prompt settlement of claims by the brokers. It is the barometer measuring the investor mood and shareholders' wealth maximization capacity of companies. Now we'll have a look at the functions of the stock exchange. The stock exchange performs the following functions and services. The first one is ready market for securities. The stock exchange provides a ready and continuous market for purchase and sale of securities. It ensures free transferability of securities. It ensures liquidity of investment in securities. Second one is promotion of capital formation. The stock exchange provides linkage between the savings in the household sector and the investment in the corporate economy. The third one is safeguard for investors. A stock exchange ensures fair dealings in securities through its rules and regulations. A strict adherence of rules and regulations and additional restrictive measures imposed on stock exchanges by legislation protect the interest of investors as well as society. The fourth one is barometer of business standing. A stock exchange serves as a barometer not only of the state of health of individual companies, but also of the overall business situation, the climate for investment and the state of the economy as a whole. Proper canalization of capital. A stock exchange not only mobilizes capital but also directs it to most profitable and productive channels. Investors like to invest their savings in securities of those companies which yield higher returns. An efficient and successful enterprise is in a better position to secure funds through stock exchange. Thus, savings are channelized into more profitable industries through stock exchanges. Next is market for gilt-edged securities. Stock exchanges provide a market for gilt-edged securities. Government securities are called gilt-edged securities. Central government, state government and municipalities issue gilt-edged securities. The stock exchanges are highly organized and have a smooth functioning network in the world. The membership of stock exchanges initially comprised of individuals and partnership firms. Then the corporate bodies were also allowed to become members. The qualifications for becoming an individual member of a stock exchange in India are: the first one, minimum age should be 21. Second, he should be a citizen of India. Third one, he should not be an adjudged bankrupt or insolvent. The fourth one is he should not have been convicted of an offense involving fraud or dishonesty. Next is he should not be engaged as principal or employee in any business other than that of securities. Next is he should not have been at any time expelled or declared a defaulter by any other stock exchange. Next is he should either be a matriculate or has the 10+2 years qualification. However, preference is given to professionally qualified persons. Now we will see benefits of a stock exchange. A well-organized stock exchange is highly beneficial to the country, community, company and the investor. These benefits are summarized under three heads. First one is benefits to the community. Second, benefits to the company. And the third one is benefits to the investor. Now we will see benefits to the community first. The stock exchange generates economic growth by encouraging investors to invest their savings into productive enterprises. The second one is stock exchanges act as a mirror through which general economic condition of the country is clearly reflected. This helps the government in designing its monetary and fiscal policies. The third one is stock exchanges facilitate mobilization of resources by self-managed enterprises. Fourth one is stock exchange encourages marketability of securities and as a result capital formation in the country becomes faster. Next is the stock exchange helps the government in raising funds from the public and thus enables it to undertake projects of national importance and social value. Next is stock exchanges provide sufficient knowledge to the investors about the market before investing in any scrip. They provide the financial information of the listed companies and also the price movements of these scrips. Next is the regulation of a stock exchange safeguards the interest of the investors by protecting them from fraudulent market operators. Next is stock exchanges protect investors from potential losses by regulating trading and checking unnecessary speculation. Now we will see benefits to the company. The first benefit to the company is a company whose securities are listed in on a stock exchange enjoys greater reputation in the credit market. Second one is companies whose shares are listed in the stock exchange get a wider market. A well diversified market in securities is highly beneficial to the company. Next is listed securities of a company enjoys higher market value in relation to earnings, dividend and property values, and thereby enabling the company to command a better bargaining power in case of amalgamation or merger. Next is stock exchange closely monitors the company's performance, and as a result the company has to maintain the financial discipline and ethics in its dealings. Next is the trading of a company's shares in stock exchanges provides higher liquidity of its shares, resulting in increased demand and higher prices for its shares. Next is the trading of a company's shares in stock exchanges enables the company to maximize the wealth of its shareholders. Seventh point is the regulation of a stock market by Sebi prevents sudden takeovers by accumulation of shares by a particular group. Another point is a company listed in the stock exchange gets quick response from investors at the time of raising capital from the market. Besides, regulations also make the listing of shares compulsory when a company goes for a public issue of shares. Now we will see benefits to the investor. The first benefit to the investor is that the investors get ready and continuous market for their investments. The liquidity of the investor's investments is increased because he can sell off his shares and realize the money invested with a profit. The second point is the investor enjoys security in respect of his investments because of strict rules and regulations of the stock exchange. Brokers who deal in listed securities are considered to be more honest. Third point is the stock exchange provides a reasonable measure of safety and fair dealing, and investors can invest their savings with confidence. Fourth one is listed securities can be pledged as a collateral security for obtaining loans. Another point is stock exchange is helpful to the prospective investors in selecting a proper security due to large publicity of its transactions. Now we will see regulation of stock exchanges. All stock exchanges were subject to self-regulation from their own management bodies, that is Board of Governors, till 1956. However, after that it is changed to three-tier regulation. First one is Constitution of India lists the subject of stock exchanges and future markets under the exclusive authority of central government. Central government through Ministry of Finance regulates the stock exchanges primarily through Securities Contract Regulation Act of 1956, that is SCRA. Second one is the Securities and Exchange Board of India, that is Sebi, also regulates the stock exchanges in order to protect the interest of investors and to promote the development of security markets in India. The third one is, in addition, all stock exchanges have their own separate rules, bylaws and regulations which are exercised through their governing councils. Now, next we will see is the role of Sebi in regulation. The central government also set up an apex body called the Securities and Exchange Board of India, that is Sebi, which is headed by its chairman. The government is also empowered to nominate 4 members to constitute top management team of Sebi. This body acquires a wide power under the Sebi Act of 1992. Since then, the Sebi has issued various rules, regulations and guidelines for promoting, developing, stabilizing and strengthening the security markets in India. The Sebi's efforts to bring reform in the capital market in future will be directed to achieve full implementation of corporate governance framework, then to strengthen the rolling settlement system, then to strengthen the clearing and settlement system and speed up the process of dematerialization and dematerialized trading, then to set up a risk management group to refine the existing margining system in order to reduce the transaction cost without affecting the safety. Then to encourage wider use of internet for trading and other activities in the securities market, to bring uniform bylaws for stock exchanges, then to increase the role of venture capital funds, to strengthen the process of book building. Next, to implement derivative trading on the exchanges, then to upgrade and widen the disclosure norms for the protection of the investors, then to strengthen the inspection and monitoring system at the stock exchanges. So that is all for today. Hope you have understood the concept of money and capital market. We will meet in the next episode. Till then, take care. Goodbye.